Are you a savvy investor trying to seize control, or a first-time buyer getting left in the dust? CoreLogic's head of research, the popular Nick Goodall, is back. What can you learn today to get your financial freedom? Find out next.
Financial freedom faster. Financial freedom faster.
Hit subscribe now and become part of the growing community that wants to get ahead in the uncertain New Zealand property market. CoreLogic's head of research, Nick Goodall, offers deeper insights into real estate trends. Nick, you've got 10 key themes for New Zealand's property market in 2025. We will look at 5 today and 5 tomorrow. So let's start with theme 1.
The first one in terms of sales values and volumes is really the fact that we're not seeing great consistency in the amount of transactions that are occurring across the country. For example, Auckland volumes are about 10% up on the same time last year, whereas in Tauranga, they're almost 30% up on the same time last year. So we are seeing some variability there in terms of the amount of transactions occurring. And that also remains true when you look at what's happening with values as well. And we've got a map that we put up, and it does have the whole country, bunch of bubbles, blue ones, which mean values are still falling in the last 12 months, orange or red ones where the values have actually increased in the last 12 months. And all I do is pay attention to some of those patterns that have emerged. Really, the bottom half of the South Island actually saw growth in the last 12 months, so that's to the end of January, whereas parts of the North Island, particularly the lower North Island, Wellington and the border region there, and Auckland and the sort of top half of the North Island, values actually still declined over that 12-month period. Now, if we shorten that to 3 months, you'd see some growth coming back. But from a broader perspective, those more expensive areas have seen values struggle along. Those cheaper areas, particularly the bottom half of the South Island, have seen some growth. Queenstown, the big difference there, it is obviously a unique place all on its own, and we're still seeing some growth in that Queenstown market as you just can't put a price on beauty.
Yeah, Queenstown, I guess similar to Auckland, there's just so much variation. And, you got to, instead of taking the mean, you got to take the median and maybe drop some outliers out. But really, what is going on in Tauranga, I just don't know. 30% change from last year. Maybe there was a bit of anxiety about the change in mayor. Maybe, I don't know. What's going on?
Yeah, well, I think that's probably more what we'd call base effects. There was actually a market that did see a reduction in transactions a year ago, and so it's coming off a low base. And so it's getting back to some level of normality now, as opposed to now suddenly things are taking off and everyone's keen to get back in. But yeah, there's probably something about certainty there. We know it's still a relatively expensive part of the country, so that won't, not attractive to lots of people, but certainly for its markets, some more certainty and improvement on last year, and things are starting to increase once again.
Great. All right. Well, let's jump into our second key theme, that listings to decline, but slowly and from a high base. Tell us what's going on.
So I think a big part of what the big conversation that we've had in the last, probably, 6 to 12 months has been this conversation about just how many properties are available for sale right now. So it's very much looking at the supply side of things. Lots of properties for sale. Buyers have been relatively restricted, though it has improved recently. And that's just meant that there's been fewer transactions, but lots of properties that are for sale means that there's lots of buyer choice. So for anyone that is actively out there trying to buy a property, there's no desperation. There's heaps of properties to choose from. If they miss out on a property, then they can just wait for another property or go down the road to one that might be for sale down there. And so that's meaning that power still sits with the buyer. They're not paying desperate prices, and that's really what's holding back some of the potential property value growth that might have otherwise occurred if we didn't have so many properties available for sale. The key point, though, the chart on the left-hand side talks about how many properties are available for sale nationwide.
Yeah.
And you can see that, we started the year pretty strong. We've got more properties available for sale today than any time in the last 5 years. And so that is just really showing that high-level figure. We do expect transactions to increase, which will start to eat into that supply as we move throughout the first, 6 months of this year. For anyone that can see the chart, you'll see there is seasonal influence of listings. So you see through winter, total listings does decline. We expect that to continue. And if transactions actually increase like we expect, then that will start to eat into that supply and start to see that fall away from a relatively high base, but it will start to drop away. The chart on the right-hand side shows you some of the regional differences, and that's a big part of our conversation right now when we're out there doing these presentations, is that you're going to see these regional differences. Much like the map before, you're now seeing in somewhere like Gisborne, the number of properties listed for sale today is much, much higher than it was a year ago. And so you might not see the same value growth in somewhere like Gisborne, whereas on the left-hand side of that chart, Northland and Waikato have fewer properties listed for sale today than they did a year ago. So it's not the same across the board. And so those areas might actually be primed for some better value growth in the short term than those that have lots of properties available for sale too. So it pays to look at those regional differences. The final point you mentioned on that byline was our watching brief on the post-Brightline investor listings. For anyone that saw us present maybe in the first half of next year or maybe from one of our conversations last year, they would have known that we talked about the fact that the Brightline test had shortened, which might actually influence some investors to sell their property sooner than might have otherwise wanted to. So they've not have to wait for their Brightline test period to pass before having to pay a capital gains tax. That's now shortened. They could sell now, no capital gains tax. And while properties were, costing them money, they're having to top up their mortgage every single week or every single month, that would have been a viable option. Now things are starting to improve. We're seeing transactions lift, values start to turn around. Maybe investors aren't so worried about that. They know if they hold longer, they hopefully see some capital growth come back. Mortgage rates are decreasing, and that's meaning their payments are reducing as well. So the finance is starting to improve a little bit. So that expectation we had that investors might list and that would boost listings, that's now starting to reduce, and we don't think that'll have as much of an influence for this year than we did this time last year.
That's great, Nick. If you really want to stay informed on property investing, don't forget to subscribe, hit that button below. Now let's have a look at theme number 3, more deals to first home buyers and investors. And that this market share, of course, has to equal 100%. So it's going to be a rise for them and it's going to be a fall for others. Now we're looking at this share of property purchases per quarter. What's going on?
Yeah, I think a big part of this conversation is around the fact that we know last year was the strongest year on record, calendar year on record for first home buyers as a proportion of all sales transactions that occurred through 2024. Now, the interesting thing is that we actually expect first home buyers to still do relatively well this year. And if you actually looked at a raw number of sales to first home buyers, we might see more sales to first home buyers this year than last year. But because we're expecting investors to come back into the market and movers to start to become more active as well, the share of sales going to first home buyers might actually reduce. And so we do think there's going to be more transactions this year, but it'll go to all three groups. So I think that's just us setting expectations for who might be active this year. And we do think that there's reason for all three types of these buyers to come back into the market. The chart on the right-hand side shows you the gross rental yield over time, and it's slowly increasing as interest rates, which is the mortgage rates on the orange line, as that falls away, the numbers start to stack up for those investors. So we see the market improving for investors. We do think there's some pent-up demand coming from those people that might have otherwise moved in the last 2 years, couldn't or weren't keen to do so. Now they might come back out and be a bit more active this year. So we do see a general market that's more active this year from all types of buyers. And that might just see that first home buyer percentage fall away, which you could see the headlines now. First home buyers share falls away as investors come back into the market, and it's all, doom and gloom. The truth is there might be more first home buyer sales. It's just their share of sales happens to reduce as well. So I suppose that's one thing to watch out for this year when you're looking at which property buyer groups are active throughout the year.
Yeah, and I suppose that with the DTIs and the LVR controls, that's going to limit investors a bit, gives first-home buyers a bit more chance. So let's go on to our fourth key theme, a potential shift to longer-term loans again. And I saw that it was very interesting to see the difference percentage share of new lending on various terms. And it looked like there was quite a good spread between how people choose to allocate their lending on fixed and floating when they're taking new loans. But the percentage share of existing loans expiry length is just a massive tendency towards fixing for that 1 year or less. And I had my thoughts on this, but let's hear yours first.
Yeah, I mean, this is your bread and butter, right? This is what you guys are talking to clients about every single day. I think the key thing we're trying to point out here is that, yes, for those people that took new lending over the last few months, there's been that massive drift towards floating in November while they were waiting for that official cash rate decision from the Reserve Bank at the end of November. But after that decision, people then pushed back to that 6-month period because they didn't want to float for too long. They had a pretty good idea about where mortgage rates were at. So they jumped back to that 6-month rate in general. Also some 12-month rate that was still pretty common as well. But this is a share of new lending. So it only actually looks at when new lending is done for a new home purchase or a top-up of a mortgage or when you switch banks. So it doesn't actually include anyone that refixed. If you just stayed at the same bank and refixed, that's not included in that data. What's really important then is that chart on the right-hand side, which shows of all mortgages that are out there today, how long have they got on their loan term? And what this is really important for is understanding how much, or what's their term going to be in the future, and when is their fixed rate coming up? And then if you had one other chart, if I had a third chart here, it would be looking at the average rate of all mortgages and the new rate they'd probably be moving to. So right now, the average rate across all mortgages is higher than what the rate of the 1 or 2 or 5 year rate is going to be. What that tells us is that for many people, they're going to fix in the next 12 months, of which you can see there over 71% of people are in that position right now, they'll be moving to a lower rate. What does that mean? That means your mortgage payments are going to reduce. That means more money in your pocket, more disposable income, and you can get out there and start spending again. That's really important when it comes to Reserve Bank decisions and their expectation about what's going to happen in our economy. I know there's a slide later on about what's happening in the economy and our expectations for GDP growth, but this is an important one to remember when we come to talk about our expectations for the economy later on this year.
That's great. Yeah, well, I mean, my thoughts on this new lending versus existing lending is there's been such a huge shift in demand for people wanting to use mortgage advisors in New Zealand. You see in Australia, UK, other places around the world, 60, 70, 80, 90% of people using mortgage advisors. And in the last 10 years, there's been that shift from, say, 40% of people using an advisor to now 70, 80% of people starting to use mortgage advisors. And what you'll find is when you're taking new lending and you're getting advice from a mortgage advisor, you're more likely to spread your loan terms and not trying to bet on the market of what's going on with interest rates. You're getting advice. Where this existing loan book, I'd say there's probably a lot of people fixing themselves on apps, not getting advice through that process, and then you're getting a bias towards that 1 year rate. So it's just a reminder, like if you're interested in mortgages and long-term thinking, subscribing to the channel is going to keep delivering you more mortgage-related content. So let's jump into number 5 key theme: debt to income ratio limits are starting to bite. Now, what's going on with the DTIs and why?
Yeah, look, you touched on it before, right? The debt to income restrictions, which limit how much a borrower can borrow compared to their income, have been in place now since the middle of last year, but they haven't really had any effect because higher interest rates limited how much you can borrow anyway. Your borrowing capacity is reduced by those higher interest rates. As interest rates fall, technically, you can start to borrow more money, and that's when you're going to start to push into these limits, which say that for first-home buyers or owner-occupiers, you can't borrow more than 6 times your income. For investors, you can't borrow more than 7 times your income. Now, there are some speed limits within this. So actually, 20% of all lending by the banks can be done outside those limits. Right now, less than 5% is being done. So there's a massive amount of allowance there for the banks to start lending outside of those limits. They're nowhere near it right now, but they will come to it with lower interest rates. Off the back of the official cash rate decision and forecast from the Reserve Bank last week, we do expect further cuts to the official cash rate that will flow through to those mortgage rates. That will mean people will start to have their borrowing capacity to borrow more than 6 times their income for an occupier, for example. Then the DTIs come in. And that's just going to start to make them consider, am I allowed to get this? In some areas, it'll be more likely than others, more expensive areas. Those are the areas that might start to use those limits up, the 20% allowance. But for investors in particular, it's going to become a big part of the conversation because ultimately, and the Reserve Bank did some analysis on this, they said that the DTIs will start to restrict how many properties an investor can own and how quickly they can accumulate another investment property. And the main reason for that is it's very hard to earn income at the same rate of the debt that you'd be required to be taking on to be active in the New Zealand property market. So it will likely start to affect investors more so than first home buyers and other owner-occupiers who only have that one property. But for anyone with more than one, they're going to start to restrict with their levels of activity. And there's one more thing to note here is we do wonder, because there's actually new builds and new construction set outside the debt to income restrictions as well as the loan to value ratio rules, we might start to see people consider going towards new builds rather than existing properties because of these restrictions, which in general is probably a good thing because we need to start to see that new build and new construction space lift up again, as it has declined quite considerably since the peak of consent sort of was up around 51,000 new consents per year a couple of years ago. So some interesting things to watch for because it will start to influence the buyer types and also the types of property that people are looking to build and buy in the next year or so.
Yeah, I mean, you can understand that first principles logic, but are the consequences of these types of things going to be what they intended to be, or are we going to see more negative long-term effects from it? Time will tell. Nick, thanks for taking us through 5 themes today. We're going to cover 5 more themes tomorrow. We're a growing community of property investors. We're trying to share all the themes and knowledge you need to build your investment portfolio. Don't forget to subscribe so you're the first to find out about the content we're releasing with regards to mortgages and property investment.
More cash, passive income coming fast. Make your money work for you. Live the dream, it's overdue.